Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, as many of you might know, I've recently been reading right through all of some of the Berkshire Hathaway annual letters that Warren Buffett has been writing every single year since right back in the 1960s, and even before that in the 1950s through his original Buffett partnership. Now, those letters are absolutely filled with gems, and one of the things that I want to talk about in this video comes from the 1981 letter, talking about some of the acquisitions that Berkshire Hathaway was making around that time, and also really the three main things that can ruin an investment from Warren Buffett's perspective. The three things that he has to avoid if he ever makes a mistake in investing. It generally falls into one of these three categories. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been my brokerage platform of choice for me as a New Zealander going out and buying shares in US companies. Previously to me working with Hatch, that was a really tricky process. I had to go through one of the big banks here in New Zealand, had to do all of my trades over the phone, pay really high fees, and Hatch has come in and made my life a lot easier in that respect. So they have very low fees. I can do the same trade that I was paying like $90 for with a bank for as little as $3. They also have much cheaper foreign exchange in my experience, and they have a very modern, easy to use platform, and it has just made life a whole bunch more simple for me trying to do my US investing. I can spend more time focusing on the analysis of companies and less time worrying about expensive brokerage or actually getting on the phone and, having to talk to people to tell them to execute my trades and all that sort of stuff. So Hatch have been a lifesaver, and they do have an offer for you in today's video. If you go to the link hatch.as/investing with Tom, sign up and start a new Hatch account and deposit 100 New Zealand dollars into that account, Hatch will give you a free $20 top up so that you can get started investing with a little bit more money. Alright, so firstly I just want to read a quick extract from Buffett's 1981 annual report, annual letter, and this is under a section that is called Berkshire Acquisition Objectives. If you want to kind of go and find the letter, I'll leave it linked down in the description below. Highly recommend reading through as many of these as you can. So basically the sort of preamble before this section I'm about to read, Buffett is sort of talking about how he'd struggled during that particular year to find a lot of private businesses to buy. So Berkshire Hathaway buys both private businesses and public companies. Depending on basically the opportunity set, they will tend to move into more heavily into one or the other, just depending on kind of the opportunities available. If private business investments look more attractive, that's where they'll go. If public business investments look more attractive, that's where they'll go, just depending on what's available at the time. So with that in mind, this is what Buffett had to say. So, currently, we find values most easily obtained through the open market purchase of fractional positions in companies with excellent business franchises and competent, honest managements. We never expect to run these companies, but we do expect to profit from them. We expect that undistributed earnings from such companies will produce full value, subject to tax when realized for Berkshire and its shareholders. If they don't, we've made mistakes as to either 1, the management we have elected to join, 2, the future economics of the business, or 3, the price we have paid. We've made plenty of such mistakes, both in the purchase of non-controlling and controlling interests in businesses. Category 2 miscalculations are the most common, and that's referring back to sort of the future economics of the business. Of course, it is necessary to dig deep into our history to find illustrations of such mistakes, sometimes as deep as 2 or 3 months back. For example, last year your chairman volunteered his expert opinion on the rosy future of the aluminium business. Several minor adjustments to that opinion, now aggregating approximately 180 degrees, have since been required. So there you have it. Even the great Warren Buffett makes mistakes, and he makes mistakes very, very frequently. And they generally fall into one of these three categories. So either they partnered with the wrong management, they were wrong on the future economics of the business, or they simply paid too high a price. So I want to walk through in more detail what each of those three things kind of refer to and try to give you some examples along the way. So sit back, relax, hit like on the video if you do enjoy, and let's get straight into that. So let's talk about the first mistake that Warren Buffett lists here with partnering with the wrong management. Now, unfortunately for us as investors, there are a whole range of things that managers of businesses, CEOs, CFOs, boards of directors, all sorts of people, there's a crazy wide range of things that they can do that can really spoil an investment for individual stockholders who don't really have much say in kind of controlling and sort of running the business. And although there are a wide range of things that can happen, there's generally a couple of key kind of ideas that push management teams into making mistakes or doing things that aren't in the interests of shareholders. And the first big one that I really like to look at strongly is simply the incentives of management. Now, ideally, what you really want as an investor, someone at the helm of that company with the exact same incentives as you. Now, the incentive for you as a shareholder is for the share price to go up, is for dividend payments and share buybacks and things over time to go up, and for you to get a good long-term return from simply holding shares in that business. That is your incentive. Now, the incentive for the management team may be different. In some cases, it's similar. For example, if we have someone as a CEO of a business who started that company and they have a very large shareholding in that business, or if they have acquired a very large shareholding in that business over time, maybe someone like Warren Buffett at Berkshire Hathaway owns about a third of all the shares but didn't actually start the business, or perhaps you have someone like Mark Zuckerberg at Facebook who did start the business and has a substantial shareholding in the company. If you're in and teamed up with one of those types of people, you're going to be in a position where the incentives of both you as the shareholder and them as the management team are pretty much exactly aligned. Now, one of the things you can run into every now and then is you have misaligned incentives. So you have you as the shareholder hoping that the stock goes up over time, and maybe you have a CEO that is incentivized on maybe one or two kind of key metrics within the business that don't always correlate with good returns over time. Now, a really good example of this would be something like a management team being incentivized based on revenue growth. Now, revenue growth is fantastic. That's something that you ideally need over time in order to grow the earnings of the business generally as well. But there are some dodgy things that you can do to grow revenue without really growing the sort of economic prospects of the underlying business. Now, for example, you can go out, you can borrow a bunch of money and you can acquire another business. Let's say you have a business that earns $1 billion a year, relatively large company, and then you borrow a whole bunch of money and go and buy another business that also earns $1 billion a year. Now, what you've done during that transaction is you've really increased the revenue of the business, and hopefully you've increased the earnings of the business as well. But whether or not that's good for shareholders is entirely dependent on the price that you paid. If you've bought a business that earns $1 billion a year, but you've paid $500 billion for it or something, enormous, and that is not something that is beneficial for you as a shareholder. You've actually damaged the long-term wealth creation of your shareholders by going through that transaction. And that is actually something that Buffett himself talks about right through his annual letters, as he has had many opportunities to buy businesses and sort of grow the pie of Berkshire. But what he would have had to give away in exchange to buy those businesses, whether it be issuing shares or whether it be borrowing money or just paying with cash that he's got on hand. There's been many opportunities where he's been able to buy businesses, but several of them would have left shareholders worse off. And just before we move on to mistake number 2, there's one other kind of management incentive mistake that I often see pop up, and this is management teams being incentivized on earnings per share. Now, oftentimes that comes across as sounding like really good alignment with shareholders. If earnings per share go up over time, that's generally good for shareholders, and if management teams are incentivized to grow earnings per share, then that is also pretty good. Now, one of the things, unfortunately, that has come in more recent years that people can use to sort of manipulate earnings per share in a lot of ways is share buybacks. And this is an issue that I've seen, particularly in the last couple of years, that has really caused at least the potential for a lot of damage to long-term shareholders. If the management team simply continues to buy back a lot of shares, kind of regardless of price, then that will shrink the overall share count for the business. And even if the company doesn't grow its total earnings, those earnings will be split over a smaller number of shares, and therefore earnings per share will go up, and that will kind of meet the management team's incentive programs, and they'll get stock options and bonuses and all that sort of stuff. But there are some issues here. Now, the main way that I think you should be thinking about share buybacks is every time the company buys back in their own shares, what they're effectively doing is buying out their business partners. And sometimes that is a really attractive proposition and sometimes it's not. And it's basically entirely dependent on the price. Now, what we ideally want to see is kind of the Warren Buffett, Berkshire Hathaway approach, where they will only buy back shares if after that transaction, the remaining shareholders are more wealthy than they were before that transaction. If their buying in these shares for below their intrinsic value. Now, unfortunately, one of the things we often see in many public companies, and even some of the largest ones in the world, like Apple, for example, is that is not necessarily the approach they have to share buybacks. Rather, they will come out and say, this quarter we're going to spend X dollars on share repurchases, and they don't even talk about price. They just put in these billions and billions of dollars into buying back shares regardless of price, and a lot of that spending on buybacks is often done above intrinsic value and can actually be quite harmful for remaining shareholders. Okay, now the second mistake that Buffett talks about here is being wrong simply on the future economics of that business. Now, one of the examples I want to use here is the newspaper industry, because this was actually an industry that Buffett was for a very long time heavily invested in. And for a very long time, newspapers made Buffett a monstrous amount of money, and again, he was able to redeploy that into other businesses and kind of continue to compound away. And if we look back at it today, even with some of the things that happened to the newspaper businesses later on, those still worked out as phenomenal investments overall for Buffett and Berkshire Hathaway. Now, the newspaper business is really interesting because back in the day, it was very much a monopoly or duopoly type business, even though there were a huge number of different newspapers all around the US and all around the world. Generally, a lot of these papers were very localized. The only way that you can get news about what's happening in your local town is you buy your local newspaper, and sort of the local newspaper in each town really had a massive competitive advantage over any more national type newspaper or any other competitor that tried to come in. There was only really sort of one or two operators typically in each city or each town, and they were able to do very, very well economically. Now, Buffett describes that even these really poorly run newspaper businesses were still earning massive returns on capital, 20-30% returns on capital, and the really high quality newspapers that were managed extremely well were doing even better. And this sort of long-term competitive advantage that Buffett saw is something that meant he invested very heavily in newspaper businesses, particularly in the 1970s and 80s, and to a lesser extent in more recent decades. But eventually we got to a point in the newspaper business where Buffett became simply wrong on the long-term economics. He expected that the newspaper business would continue to chug along basically indefinitely and continue to return these very high returns on capital, and that simply hasn't happened. We've had the internet come in and displace many of those businesses. We're able to have news spread at a much, much lower cost than physically printing the materials when it just pops up on your phone and so on, and Buffett was simply wrong on the longer-term economics of the business eventually. Now, the third and final thing that can ruin an investment from Buffett's perspective in this letter is simply the price paid, overpaying for the business. Now, this is a relatively straightforward one, but it is absolutely essential to good long-term investing is to pay an appropriate price. Now, I really like using just a rental property example in this kind of analogy because I think a lot of people can relate to it, and it keeps the maths kind of simple for me. So let's say you buy a rental property down the street. It's going to earn you, I'm going to say $50,000 a year. After you receive all your rent and you pay all your expenses, that's kind of what you get to keep pre-tax, say $50,000 a year. Now, when you go out and buy into that real estate property or buy into a business would be the kind of analogy here in the stock market, you really have to look at what is a reasonable price to pay for that $50,000 in earnings. Maybe you're in a growing area and you expect that $50,000 to go up over time. Maybe you're in a declining area and you expect that $50,000 to go down over time. You really have to make a judgment call on what you're willing to pay based on what that business or that real estate is earning today and what you expect it to earn out into the future. Now, let's just assume for this example that that $50,000 income is going to be fairly stable over the next, say, decade, or at least that is your kind of thoughts. And that house is getting offered to you for, say, $500,000, about 10 times what that earnings power of the real estate investment is. And with interest rates near zero and long-term stock market returns maybe being 7 to 10% per year, that 10% really consistent income from that real estate property might look really attractive to you. And if that real estate property happened to be also listed on the stock exchange, what you may find is that you actually get much more wild swings in the price of that real estate when it's traded on the stock market. It'll still earn $50,000 $100,000 a year like clockwork, but you might find that the sort of stock price, if it were listed on an exchange, might fluctuate from anywhere from $300,000 right up to $1 million. And depending on what price you paid, that has a significant influence on your returns. If you can buy that real estate property on the stock market when it's trading at that $300,000 price, you're now earning 50 grand a year on your 300 grand, and that is a much higher yield than if you had paid 500,000 or even $1 million. So price is very important, and when Buffett talks about that being the mistake that can really ruin an investment, he's basically talking about paying more than you should for the earnings power of those businesses. And often, frankly, it's tied in with the previous mistake. If you look at the newspaper companies, Buffett thought that they had really good prospects moving forward. He thought they were going to earn a lot of money, and therefore he came up with what he thought to be an appropriate price to pay for those newspaper businesses at that time in order to earn a really good return. Now, since he was wrong on the future economics of the business and they didn't earn the money, sort of like our real estate investment maybe goes on to only earn $30,000 a year on average, it didn't kind of show up in terms of its long-term economics as much as we thought, that can all of a sudden make your purchase price look more expensive. So although something might look attractive at the time, really you have to try and match it up with the future economics of that business to really figure out whether you think that is a good price or not. So those are the three categories that Warren Buffett lists as what mistakes can typically fall into with his public stock market investments. So I do hope you enjoyed, and I hope you got a lot out of that video. Now, if you're interested in the Hatch offer, you'll need to head to the link on the screen here, hatch.as/investingwithtom. It will also be linked down in the description below, so definitely feel free to check that one out. But that's all from me today, and I will see you in the next one. Cheers.